This episode of the Old Dogs REI Network is brought to you by Mino Studio. Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Hello, old dogs, and welcome to
Fun Facts Friday.
This is our once-a-week, only on Friday show, where we have special episodes not featuring guests, where I will share tricks, tips, terminology, and techniques that will help skyrocket you to real estate investing success. Today's topic is 12 common mistakes real estate investors make and how you can and should avoid them. But before we get started, I like to touch base with you guys and just see how you're doing and see what's going on out there in your little world. And as we all are seeking to examine the possibility of real estate investing as a means to supplement our retirement, I'm hoping that things are going good because, I'm not hearing from anybody recently. And so I'm just assuming everybody's doing great, that you're just well along in your way. And if not, you got questions or concerns, write to me. Love to hear from you guys. So, right now it's really email bill@olddogsreinetwork.com. You can write to me and, I'm thinking about getting this little thing where you can Calendly or something, I don't know, and you can just plug in there and take a time slot, but that's so high tech right now. Okay. I'm getting there. I'm trying to be a little bit more techie here. You'd think I would know. I was in the software industry for years. Okay. But nonetheless, hey, let's get to our tip of the week. Generate referrals. Okay. Savvy investors generate a large portion of their business through referrals. Because of this, it's important that you build a network and treat other investors with utmost respect, and that you make some contacts, and don't just make them, but that you would groom those contacts to be lifelong, business associates. Now, this may be people who are business partners. It could be clients, tenants, anyone with whom you've had a relationship with in the past. Real estate investing groups are prevalent, and burning one bridge may potentially lead to many more burned bridges. So if you can get out there and network, okay, the best real estate investors pay extremely close attention to detail. They're also typically very open to feedback, including complaints and concerns, and represent their business in a positive manner. This allows investors to build the kind of reputation that makes other investors interested in working with them in the future and referring their friends as well. I try to make it a regular practice, to meet folks for either breakfast or coffee. I like meeting early. Could be tea, if you're not a coffee guy, chai tea, tai chi, I don't know, tai chi, you could do tai chi, you could do kung fu, whatever, just meeting with people on a regular basis and trying to make yourself available and just, get on the phone. I know most people just don't even like to call anymore, but that I'm an old school guy. I love to talk to people, but texting is always so much easier, right? But, we all get tons of texts and it just gets kind of nuts. But I try to, say, hey, let's set a date, set a time where we can get together and just chat, even if I don't have anything in particular to say, because some folks, are just, have become good friends now. And we refer business to each other and all kinds of good stuff. So that's just a good thing, a good habit to get into. And, I know that there are sort of, those Okay, I'm just having an old dog moment here, but what they call those things, you kind of manage your contacts, contact management software or something. Anyway, so you can have it. You can plug this information into some really great things out there that we've talked about on the show. In fact, a lot of my guests just say, their favorite app is this, and there's a lot of them there, so you can get them. I used to use Act. I don't even know if that even exists anymore, but I used to do a lot when I was doing a lot of marketing stuff. But I know there's some that are much more robust and easier to use nowadays. So get your contact management software. Have it pop up every 6 months so you can contact somebody, or 3 months, or whatever it may be. These are great. Is a great part of real estate. A great part of it is just building those relationships. Okay, well, let's go into our topic here. 12 common mistakes real estate investors make and how you can and should avoid them. Now, real estate investing can be a profitable and worthwhile financial venture to build cash flow, obtain a great return on investment, and to build a legacy for your children and your children's children. We've talked about this time and again on this show. However, be wise and understand that you can achieve significant success sooner by avoiding common investor pitfalls. And I've talked about this before. Starting later in life, you just don't necessarily have the time to make a big mistake and have to recover for it, or multiple big mistakes and have to recover from it. And some of the ways we avoid that are really getting a mentor, putting a plan together, doing some just real common sense things that we've talked about before that can help prevent a lot of mistakes happening. You're going to have mistakes. They happen, and they're great when they happen because they're learning lessons, but they can also be very costly, and they can also eat up a lot of time that we don't have. We want to be able to, build up our portfolio and get it where we want it and get on with life, right? So let me look at some of the common mistakes here. There's 12 of them, so I'll try to zip through it as quick as I can. The mistake number 1, spending thousands of dollars buying books and tapes and attending seminars and then putting all that in a bookshelf and never looking at it again. I have one of those bookshelves. I have a lot of those home study courses and other things from boot camps I've been to. And luckily I do reference them, but not that often. So you want to be wise. I'm continually amazed, though, at the number of sort of would-be investors that have spent all this money on seminars and coaching and all this, and they never use any of it. So, if you're going to commit to spending the money, you need to be serious about it and be focused. One way to avoid getting a lot of things in your shelf that I have, like on wholesaling and all kind of flipping and all these things that I never ended up doing, was to be focused and really zero in on that one niche. And if it's rental properties, stick to rental properties. Don't, after a while you build up and you reach your goals, great. Then you can start venturing into other areas. But that's part of the problem, is we lose a lot of time just doing all that. Mistake number 2, failure to learn the basics of real estate investing. So this is kind of the extreme of number 1, is that the best way to accumulate wealth and venture into the purchase of properties without knowing the basics of real estate investing is you really need to get the basics down. And whether you pick it up in books or podcasts or YouTube's videos, whatever, you've got to get the basics down, the key fundamentals, and you stick to the fundamentals, you're going to be okay. Number 3, fear of making a huge financial mistake. We all have our degree of fears, right? Some more extreme than others, but we all are afraid of making mistakes, especially a large financial one, especially when it comes to your hard-earned funds that you've been working a lifetime to build up. So if you follow advice number 2 above, that I just mentioned, failure to learn the basics, you're gonna have some issues. But you learn the basics, you get the fundamentals down, you make good decisions. Number 4, not looking at more properties. some of us just are so excited about real estate investing. We're out there, we find this property, and it looks like it's the be all end all, and we kind of run into that thing that happens to people buying single family homes as their first home. They're in love with the house and everything, but we're not taking the time to really dig into it and do all the due diligence that we have to do in the underwriting to make sure that this is a sound real estate investment. So don't fall in love with the first property you look at. Okay. Number 5, a better deal may be around the corner syndrome. Okay. This happens a lot with people too. It's a great deal. It looks fantastic, but, you're not pursuing it because you think there's going to be something better. This is sort of the opposite of the one I just mentioned. This investor never starts his or her real estate investment program because they're always hoping a better deal will be out there. If it meets your basic criteria, and I really recommend you set strong criteria. If it meets your criteria, then go for it. Especially if you've done your due diligence and your underwriting properly, just go for it. But that whatever that pot of gold at the end of the rainbow isn't always going to be there. Okay, let's go to mistake number 6, thinking that real estate investing is strictly a complicated game that only the wealthy can play. Guys, I'm living proof of that. Okay, I jumped into this not knowing anything, and I survived. I'm still surviving, but now I'm surviving a little better than I was when I started. So anybody can learn this. If I can learn it, anybody can learn it. I had no real estate background, and I just tried to make right decisions, and you can do the same. First of all, real estate investing isn't complicated if you learn how to do it first, okay? Did you know that even professional investors use a simple sort of 9-step process to analyze the financial feasibility of an investment property? And I'm going to just share those 5 things with you really, really quick here. Okay, so don't be afraid of it. There's 9 simple steps that everybody uses. Okay, number 1, schedule gross income. Income if 100% leased. Okay, you need to know that number. Less, okay, number 2, the allowance for vacancies. Okay, so and that varies depending on what kind of property it is. Number 3, operating income before expenses and mortgage payments. So you need to know those that basic information. Okay, now less your operating expenses. That's taxes, insurance, utilities, repairs, and maintenance, etc. Okay, equals your operating income. Okay, that's your income before mortgage payments. Okay. Minus, okay, those mortgage payments equals your cash flow. Okay, do you get that? So it's scheduled gross income. That's the gross number of amount of money you get from rents. Okay, less allowance for vacancies. You got to allow there because there will be those vacancies and they'll take away from your cash flow. Then minus your operating income before expenses and mortgage payments, less operating expenses. Okay, so equals your operating income. Okay, minus your mortgage payments equals your cash flow. Now, plus, if you want to get your total here, your mortgage principal payment, and to factor in your total return. So there's a lot more to it than that, but that's really the basic 9-step procedures. And I'll have a link to it so you'll be able to see it in our show notes. Mistake number 7, falling in love with the property. Once you've got your feet wet and become a real estate investor, you'll wonder why you waited so long to begin. Now you'll face another problem, falling in love with the property. They've seen how well it is doing. Cash flow has been going up each year, and they've fallen in love with this and with the tenants. There's there's 2 big issues here. One, first, never fool yourself into thinking your property is doing well enough to sell or trade because your cash flow is considerably higher than when you purchase the property. The second part of this mistake is getting so friendly with your tenants that you fail to maintain rental standards based on what the market will bear. This greatly hinders your growth potential. So you love a property, it's just a cash flow machine, but you have to really be realistic about what your what your cash flow is and how to maintain it. And also don't forget your tenants. Yeah, they're great and they pay the rent all the time, but you've got to also maintain, some standards there so that, I'm not going to raise the rent this time. And, maybe you just raise a little less if you're having a hard time with it, but you need to continually increase your cash flow. Okay, mistake number 8, failure to effectively plan your financial goals. Before you purchase that first property, which of course you have financially analyzed, determined what you expect from your investments, okay, your financial goals. It is known as the time versus money concept. The more you have of one, the less you need of the other in order to reach your financial goals. So have those goals in mind. And again, we talked about criteria and other factors there. You buy the right property, it meets the right numbers and the right criteria, you're not going to have a problem with it. And hopefully it will not eat up your time, okay? But it'll continue to produce significant cash flow. Mistake number 9, trying to purchase properties that the seller isn't motivated to sell. Buying off-market properties is a wise strategy, and we talk about that quite a bit here, that can generate built-in profits. However, I have seen potential buyers continually try to purchase investment properties that owners are just not interested in selling. This includes property owners with the attitude that sure, it is for sale for the right price. Unfortunately, the right price isn't usually what's going to make financial sense for you. So if they're just not going to budge, you're not going to change it by continuing to talk with them and negotiate and renegotiate it, because it's just going to take away from your goal. You got to meet your numbers, and if you don't meet your numbers, move on. Okay, mistake number 10, believing you can get rich overnight. Okay, how many people listening to the show believe this can happen? Okay, overnight ain't gonna happen. Over time, it definitely can happen, but you have to be wise. Getting rich overnight is, a lot of people are selling their programs this way, and it's a shame because it gets people's expectations up, and they just get so discouraged because it's not happening fast. It takes time, hard work, knowledge of real estate investing to really maximize your returns. You're tweaking numbers. You're changing light bulbs. You're doing things to try to maximize that cash flow. And there are, it's a process, and you're learning as you're going. But if you can stick with it, the persistence will pay off. I will tell you that, but it's not going to happen overnight. You need to work it, and you'll get better and better at it, and it will go a little faster, but it takes patience and prudence. Okay, mistake number 11, not financially analyzing a potential investment property. This is the most serious mistake an investor or potential investor can make. I have seen a few pros in the business rely on a worthless and inaccurate rule of thumb to make a huge financial purchase decision with total disregard for how well the property will perform. Now, those of you that have used our rental property analyzer, for example, there's a lot of rules of thumb in that mix. All that's meant to do is to bring a potential property up to the surface so you can dig deeper. But don't rely on those rules of thumb for your hard investment dollar. You just it'll help you to sort your potential properties into categories, and that'll allow you to dig deeper. So it is all in the numbers, and you make sure you're carefully collected the right data, and that you're allowing for all contingencies, and that the numbers work before you buy. Yes, those are key things. I got one more mistake here. Number 12, thinking it is important to pay off your mortgage as soon as you can because mortgages are a necessary evil. Now, this is one of those debatable areas. I'll tell you that right now. I like the appeal of being totally debt free. I really do. I like the idea of just getting straight cash flow, setting money aside for the things that you need to set it aside for, but not having to deal with the mortgage. Yeah, we all say, it's great. It's a great write-off. I have excellent write-offs. First of all, as a real estate investor, mortgages are an important part of financial success and not a necessary evil. You must learn why this is true. You must learn how, in the right situation, a second or third mortgage can be a nice thing. thing. Secondly, mortgages are one of the keys to generating wealth in real estate. You must learn how to use financing as one of the keys to building a profitable real estate portfolio without concern for it being risky. So when you do have a mortgage, okay, and you're not buying properties for cash, okay, you do have that buffer there. You have this other cash, okay, that you didn't spend. Let's say you got a $100,000 property and you're only putting, $20,000 on down to buy that property. Well, that gives you another $80,000, right, that you can spread amongst other properties, and you're reducing the risk. You put all of your eggs in one basket, as old timers say here, is then you run that risk if something happens to that property. I mean, maybe there's a flood or something or a tornado and you didn't get that insurance or whatever might have happened. Boom, you're done. So there is an advantage to being able to spread things out with the mortgages. But once your properties start to prove themselves, you'll have some that I got to get rid of this property. And so you have that flexibility. You haven't thrown all your cash into it. So you have the flexibility to be able to to say, okay, this is a dog. I'm going to sell it, and I'm going to sell while the market's up like it is right now. And I did that. I sold some of my properties, and I'm really glad I did. And I used that cash for other properties. And so, and then what you can end up with is just a stable here of some great properties that are just cash flow monsters, and they're producing for you, and they're good, and you're always getting good tenants, and all the good stuff is there. And so those you want to pay down, and I would say accelerate your mortgage and get them paid off. And when you're old and eventually you pass away, you can hand this debt-free, properties to your kids to be able to hopefully take on and not just sell and get the cash. Although that's their prerogative, but hopefully they'll be able to latch onto that property, and that'll be part of that legacy you'll be able to hand down to them. And I've said this to other old dogs out there too, that that you may have a kid that really wants to do something that they really love to do, but maybe they just don't make that much money doing it, and it might be tough for them to buy a home and have a family and do all the things they want to do. But if they've got rental property, it doesn't really matter. If they want to be an artist, they want to be a musician, like some of us crazy guys that thought one day we would be rock stars, let them go for it, But the cool thing is that the cash flow will keep going if you can teach your kids how to maintain it, how to keep that property going, and that they can hand that down to their kids and your grandkids and great grandkids. And so it does work. It does work. But these are mistakes that you can know about now. And again, I'll have links and all kinds of stuff in the show notes here, and all of these recapped for you, so you don't have to worry about writing them down. They're all in our show notes. But if you could at least avoid some of these mistakes, it will reduce some of the risk, and it'll help you to get where you want to get faster. Well, that's it for today. Please note, Old Dog listeners, everything presented here today can be accessed in our show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode entitled 12 Common Mistakes Real Estate Investors Make and How You Can and Should Avoid Them. Well, remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.